All right, last year on May 16th, I was sailing around the Caribbean on my 20th anniversary with my beautiful, sweet wife, not caring at all what the markets were doing. Today, a little bit of a different story. So I am in town still, but now 21 years married to my beautiful, sweet wife, and the markets continue to rally. And the question is, are we out of the noise? Are we bouncing? Are we back to this bullish trend? Is this intermediate run starting now, or are we still in this noisy period where we can still have some weakness or strength? We haven't really broken out one way or the other. So I continue to break down the technicals so we know what to expect, and not only what's happening, but also what to expect and how to manage that. And we also take advantage today of a sector that's not showing this nice little bounce that we've had for a trade opportunity there to see if we can take advantage of weakness in that sector. So let's go ahead and get started. Today is Thursday, May the 16th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, now let's take a look at the S&P 500 here with the Market Forecast Indicator. Not surprising, a little bit of an update today, and get a long upper shadow too. So we didn't close at the high; it pulled back a little bit. Short-term sentiment did rise. Near-term line back in the upper reversal zone. We haven't cleared this near-term high here. That's when you have a really bullish near-term high point, when this gets above 80, and we clear up to a higher high. So just keep in mind, we got up to it on an intraday basis. We weren't able to clear it, so that's important for tomorrow to see if we end up getting this bullish near-term high point. The momentum line also turned up, or stayed up, went up at a higher pace here. Short-term sentiment lines rising. It's a good sign. The intermediate lines kind of flattened out. Still has the dark pink shading, so it's still down a little bit. But the fact that it's not like dropping significantly into the reversal zone is a good sign in terms of the type of intermediate pullback we'd like to get. We don't want to get one of these kind of intermediate pullbacks. We'd like to get one of these. At least that's the expectations that I have. So, that's a good sign. Now, I don't think necessarily, so we have closed above the high of the low day. So whatever one of these days was the lowest day, if you can see it within all that mess, then we have now closed up above that. So that's a kind of a bounce signal, but I don't think necessarily. Of course, as I said yesterday, and I've said in other classes here at Market Scholars, we have to really clear this 2,900 level before we say, okay, now we're closing. Now we're having this type of breakout move like this one that's starting to move us higher. Obviously, we'd be back up above a moving average. Depending upon how far up above we got it, it might turn it green, which is the bullish signal. At that point, away we go. Until we get to that point, we're going to have some weakness. So, with short-term sentiment bouncing and not getting into the lower reversal zone, another good sign that, this isn't that bearish of a pullback. I know, we had markets in turmoil, and the fact that we get markets in turmoil on retracement moves is a little frightening in terms of the fact that we can't trend, right? Trends, the definition of a trend is a series of higher highs and higher lows. If we can't have higher lows, then we can't trend. But we have these moves which produce ultimately the type of pullbacks we saw last year, right? At the early part of last year. We get that kind of a move because we can't get a higher low without the markets having, going into turmoil. Or eventually we get this kind of move, right? And when things really pile on. And so, the fact that we had a 23% retracement and markets were in turmoil, that's a little concerning about the state of investor sentiment. Again, pretty much that's the definition of weak hands when we can't handle that a little bit of a pullback and see it for what it is, an opportunity for new intermediate run to develop. In this case, another 1 to 3 month rally. Now, unlike this one here, this is the type of intermediate rally I expected we'd get. A little different in the fact that the 3 red arrows days you'll see here in a second didn't set the low point. We went a little bit below that, but we also had a much steeper rally than before that one. And so that's why we had more of a pullback now below the moving average. It was a lot longer of an intermediate run. This was only a couple of months. This one went 4 months, went a month longer than normal. And the upper end of normal is 3 months. So it went a month longer than the longest normal. So again, that's why I think, this one only lasted about a week and a half before we got back above it and took off. I think this one's going to, of course, anything can happen, right? We're so beholden to headlines right now. But considering the technicals and considering how long we're bullish, and this is the only significant exhale that we've had so far since Christmas Eve, don't be surprised if we can't get above 2,900 at least this week and into next week even, and potentially even come down and retest these lows in the early part of next week. Maybe even a little bit lower, maybe even down to this 2,780, 2,800 level before we eventually then bounce back up and work our way up to, the new, close above the high of the low day type signal. You see the Dow Jones Industrial Average, its moving average is falling here. It has a bullish posture. The intermediate line has turned up. So again, a good sign that we're not like tanking into this reversal zone. And we're not really dropping to significant lows on the near-term line either. But it's a pretty bearish pullback there. So again, we're probably not going to immediately bounce up here. Of course, anything can happen, but that's not the expectations. NASDAQ looks very similar. The S&P and the Russell also look very similar. I had more of a pullback here on Monday than the rest of them did because we broke through a lot of lows. And as of right now, all we're doing is retesting those lows. So we haven't even gotten back up above those lows in the past 3 days, and obviously still below the moving average, and obviously still bearish posture, dark pink shading. So we're not out of the woods yet, but the woods are, these aren't the dark woods, right? These are, this is normal. We're having an exhale. I don't think the exhale is over with, and I think we still have, another week to go or so towards the end, another week plus before we finally establish a good solid base that we can bounce off of, and then expect with good odds a decent intermediate run to come out of it. All right, before I show you some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. That notifies you when these videos are posted. Hit the thumbs up icon down below the video. That tells me that you want us to do this video again tomorrow. Quick way to give us feedback you can do right now while you're watching. Comment down below on anything that stood out to you from today's video. Join our Daily Market Outlook email list. There's a link popping up right there in the top right corner of your screen. Click on that link to subscribe. Very easy way to do that. Follow me on Twitter for more content like this in between videos from day to day. And join our Market Outlook community that we created on Facebook. Also, a quick heads up too, if you're watching our Market Outlook video here on our blog post, we look for 3 clicks here. Number 1, click on this heart. That will open up tonight's Market Outlook tweet. You can like that with that button. Number 2, click on this image. This takes you to your Facebook page where you can like today's Market Outlook Facebook post. And then 3 here likes this here on our website and our community. And obviously getting points in our community for engagement on our site. Of course, here's a very easy way to subscribe to our email, our daily email. You can also share the Market Outlook video across these different networks by clicking on either of these buttons, including the email here. And then finally, our schedule over here on the top right of classes, as you can see for next week, as classes for this weekend are canceled, as I'm out of town the rest of this weekend. So this is starting next week here on May the 20th. All right, let's get back to the charts now, and you can see this week's candle. You can see we're getting pretty big ranges after small ranges of 37 points, 26 points over the course of a week, 43 points, 53 points. Then we got a range of 112 points essentially, and then this week's range is 90 points. So we're getting some relatively wide ranges. Increase in volatility, not surprising, right? But you can see how bullish this candle is, and depending upon how we finish. Remember the Hakinyashi candle is pretty bearish here, and unless we break above 2,900, 2903, We're not going to get a long upper shadow here, but if we finish up towards 2903, then we set up for a transition candle back to a bullish move that quickly. More likely, we'll probably come back down towards 2850 or lower, and that would set us up for more of a bearish candle heading into another bearish Hakunashi, which would not be surprising. That would actually be expected if we get another one, maybe two of these kind of bearish candles before we start getting the transitions like these that lead us to a more of a bullish, or even this one here that leads us to a bullish reversal, or in this case a bullish bounce, because it'd be similar to this intermediate pullback here where we only had one, but here we only came down to the 50-day moving average, and we're kind of trading in between the 50 and the 200, which usually leads to a test of the 200 with one or two more of these bearish candles. Then we get the reversals and the bounce back up. Let's take a look at the 3 green arrow chart. I remember we had yesterday the green arrow on the stochastic, still the case. We're not above the moving average yet, and the MACD is usually the last one to come across. You can see it's still not above its orange line. That's what produces the green arrow on the histogram. You also see that we're not above 0 yet, and we did get above the 8-day moving average today, but still holding the 17-day. So keep an eye on that and see if we end up holding that 17-day with some weakness and get back below the 8-day and trade within this range. Not necessarily below 2800, but back towards 2800 with the MACD still below 0, stochastic still below 50. We're not out of the woods yet, but relatively positive signs at least keep us from being extremely bearish to the downside. All right, now let's take a look at the intraday chart, and you can see we filled in the rest of that gap. I tweeted that earlier. We noticed we got back in the upper half of the 4-week range, and now retested it by the close. Probably going to come back down towards this 285.76 area, maybe down to 284 by tomorrow, assuming we get a continued weakness. Otherwise, remember 290, that's the top end of this Hakunashi Open. We get a breakout above that or even close near that, then that sets us up for that transition candle for next week, and we might get that bullish bounce a week or two earlier than expected. All right, when you look at today's volume and trading range, you can see we are just a little bit above the range of the day. Remember, a little bit of a gap up to the upside. We closed 28.50.96. We opened today 28.55. So we had about a 5-point range. So you add that on. In fact, if you take a look at SPY, the range is just a little different. You had the close yesterday at 285.06, and today's low point 285.76. So we had about a 7/10 of a point to that low. So you add 7/10 on, so you're over 4 points on the range, so a little bit above average when you include the overnight trading. And also you can see too from a volume perspective, volume kind of matching what we saw in yesterday, about a 76 million. So put that in context here. 76 million shares, right about the average, but again low in the range, in the 52-week range. And then the range here, 4 points, also above average, a little bit above average, but lower towards the end. So again, it's the 5 to 6 points, it's the 100+ million. Those are the bearish volumes, and we're not getting those, at least consistently. So again, another sign that this is a nice pullback, right? This is not markets in turmoil that we see so often. Finally, let's take a look at the volatility index here. You can see the volatility is already back down below 16, so 15.5 into the neutral zone with the breakdown today. So we'll see if we end up popping on this, or if, because once we break below 90, then we're back. The bounce has occurred, right? That's when, as we saw before, you get back below 90. Here's the intermediate pullback. We got back below 90. The bounce has occurred right there. So we're not there yet, but we're moving towards that direction. Again, we're not bearish, because otherwise we'd be up here towards 1, and we're not. But we're not that, we don't have that bullish kind of bounce signal yet that we're ready to go here until we get back below 90% on this volatility index. So to summarize, our outlook looks very similar to what we had yesterday. Today's move, again, it looks like we're bouncing, and we very, very well may be bouncing, but it doesn't. We don't have all the signs yet across these different charts that would suggest it's established. There's still, there's a possibility, and on my end at least, expectation that we'll still kind of get some noise and some pullback into this week's lower end of this week's range throughout tomorrow and into early next week. And then after another week or so, then we'll start to get that transition towards a bounce. Because again, on the other side of the coin, we haven't had bearish enough of these types of signals to suggest that we're going to get the type of drop that we saw in October and December of last year. So it's looking good for the nice, good intermediate pullback. Not a market in turmoil, but it's not quite there yet that we're ready to go now for another 1 to 3 month intermediate run. So what do you think about that outlook? Do you agree or disagree with that? There's a link popping up there. Click on that link. It opens up a poll. Then hit either agree or disagree in that poll. If you click disagree, comment down below on the YouTube's page on what you see that would suggest otherwise. Maybe the bounce has occurred according to some things that you're looking at, or that we are more bearish and we are going to have that type of October, December move with some things you're looking at too. So make sure you share what you're seeing with our Market Scholars community down in the comment section below. All right, if we take a look at now what's driving price action, you can see, we've had this nice little bounce over the last few days. You notice what hasn't really bounced. We've had one little push up here in emerging markets, but really emerging markets, the gap between has gotten bigger between emerging markets and other equity asset classes. Crude oil has moved back up to the upside, along with other, this over a 2-week period, mind you, other safe haven asset classes like long-term bonds and gold, right? So those two are up there, and you can see the dollar flat and high yield down below it. You can also see 2 agricultural commodities. So again, a lot of using that as a proxy for trade, sentiment, market sentiment towards the trade war, and not just like media sentiment towards the trade war. You can see agricultural commodities doing really well. So that you can see why equities, but interestingly enough, it's not the emerging markets that are picking up. In fact, if you take a look at the emerging markets here, whoops, not that one. It'd be this one here. Well, let's just give it a second to load up. There we go. So let's go to the foreign markets is what I wanted to look at, and then over here I wanted to bring up the watch list. So you can see Argentina was the one. But then you have Switzerland, Canada, Australia, Russia's doing well, Germany, Spain, United Kingdom, U.S., France, Netherlands, before you get to U.S. small caps, and then the ACWI, the benchmark. And then you have all these, Japan's really one of the only developed markets in Italy that they came in below the benchmark. All the rest of these are emerging markets. Or, excuse me, these are over the last 2 weeks. Over just today, you can see again Argentina doing okay, some good gains here. But look at the bottom end: Poland, Indonesia, Brazil, Turkey, kind of the small caps of the emerging market space. Korea, Thailand, Taiwan, Mexico, Russia, in China, all of them were the worst performers. You can see, they're coming up, and they've got the S&P is right on its moving average. Germany's back up above it. France getting close to it, UK a little bit below, in Italy, and Russia's getting back close to it, Canada. But a lot of these emerging markets, Brazil 3-month lows, Korea close to its 3-month lows with a cluster here a couple days ago. China's still well below its moving average, India. So we're not getting that nice little renewed strength in emerging markets like we are in the U.S. stocks. In fact, if you look at the relative rotation graphs from stock charts, you can see emerging markets are all headed red, right? These are all the major that we track here, all the ETFs of the major emerging markets relative to the benchmark ACWI. You can see there's only 2 that are still outperforming the benchmark, and that is Taiwan and India. They're showing relative strength. Everything else is headed red. Now, Mexico is turning higher. Russia is turning up and gaining some momentum to the upside. Turkey is down. Brazil's, the relative strength is heading down. Indonesia, this is on a weekly chart, mind you. Indonesia and Poland, you can see Korea, you can see is heading lower. Thailand, Argentina, which was doing really well, has come down, and then there's China. So you can kind of get an idea of how right now where the strength is. If I were to throw on just to kind of show you where SPX fits into this from from a U.S. standpoint, compared to these benchmarks here. Let's see, did it not go on? It didn't go on, so let me get that on there again. There we go, and then update. Then you can see, there we go, SPY here you can see is also outperforming relative to ACWI. And then if you were just to pull up and just add on, not necessarily the emerging, the individual developed markets, but just the ETF for all of them, there's EFA. So EFA has got stronger momentum than any of these others, even if it doesn't have, except for Mexico, even if it doesn't have relative strength yet, like these three up here. So emerging markets, really, I mean, they're struggling. If I take out EFA on this list, and you look at just the emerging markets, take off, well, we'll leave SPY on there, and look at them relative to EFA, they're all struggling too, right? I mean, there's a couple. I mean, China is just in the weakening here, hasn't fallen in relative strength yet, and Argentina hasn't either, and actually rolling up, and like you said, Mexico and Russia are looking good, but all these others just really struggling against developed spaces. So these, like I said, these are Turkey, Indonesia, Poland, Thailand. These are kind of like the small cap stocks of the emerging market space, Argentina as well, whereas your big caps are kind of your Russia, China, India. There's Taiwan up there, Mexico also, kind of mid space. You have Brazil, Mexico, and Korea kind of in that mid space, and then all these others in the small caps. Let's take a look at the calendar. And we can see busy day today, housing starts. Remember, the general trend is this peak in August. This would be over here in August. This housing peaked actually a little bit earlier. And then this kind of general decline. We did have a bounce up, but again, we've had 1 month bounce. So we have to continue that to get the trend going back up again on the housing starts. Remember, the Empire State Manufacturing yesterday was strong too. The Philly Fed also strong up again. So you can see it's kind of bouncing up, and it might be changing the trend. Remember, this is soft data, survey data. Soft data tends to turn before the actual data does. So that's a good sign that those two surveys are turning higher. And tomorrow we have another soft data point with consumer sentiment coming up. We've still got some pretty negative indicators as a whole over the last 3 months, relative to their estimates, according to the Economic Surprise Index. Once we start beating estimates, that means we're going to have a good trend back up here above zero. The odds of a rate cut are still relatively high at 70% versus 0% for rate hike by the end of the year. And you can see GDP estimates came in again today at 1.2%. So up a little bit from yesterday's estimate of 1.1, but relatively low compared to what we've seen the last few quarters for GDP. So now last quarter's GDP started out really weak from an estimate standpoint and rallied and got close to 3% by the time it was actually released. We'll see if we get a similar trend on this going forward again, but not necessarily the most dollar bullish macro environment, even though this dollar breakout that we're having, appears to be holding because of how bearish things are globally. There's a nice little bounce here back above 97.5. Good move today. If we get above this 98 again and hold it, then this expected weakness in the dollar narrative, even though the yield environment and the macro environment from an economic standpoint are relatively bearish here in the U.S., the fact that they seem to be more bearish and yields are higher than anywhere else here is attracting some moves. So whether or not that will be like a multi-year run for the dollar or just kind of more of a multi-month run, because we are in that kind of inflationary late cycle stage of this business cycle, where commodities, we've seen crude oil taking it, making a move and getting back up above itself off of these Fibonacci retracement lows and bouncing. That's usually when inflation's rising. That's usually another bearish dollar environment rather than a bullish dollar environment. So I'm not, while we may be bullish on the dollar for a while, it shouldn't be too long before it shows some signs of weakness again if this little breakout holds. All right, from a sector standpoint, it's interesting to see over here financials. We had a drop, a rise in yields today, benefiting financials. You've got a cyclical sector here in consumer discretionary and technology. Materials and industrials are leading today as well, especially materials, even with the weakness in gold. So kind of interesting to see that pattern. Safe haven struggling, even with crude oil rising today. Energy stocks still continue to lag behind, and even lagging behind the safe haven areas. You can see your safe haven areas over the past 2 weeks are still showing relative strength because of they've held their value better during the pullbacks, and they're bouncing up along with everything else. And you can see the areas that have had the weakest 2-week returns are starting to make their runs back towards the upside again. Even though these haven't necessarily crossed that S&P threshold yet and started to show, you can see on some of these others, they've been down during this whole pullback. They've been leading the way lower, and now starting to make their run higher off of Monday's midday low point here. And you remember how we have some divergence among some of these sectors. We've got still some pink charts here, which means we have falling moving averages, dark pink shadings. First of all, we have dark pink shadings still in the S&P because it's falling, but industrials, discretionary. You have red lines on healthcare and on industrials. You have dark pink shading and red lines on materials and energy. So we still have some bearish patterns here. These aren't the most bullish patterns, and the patterns you see actually in real estate and utilities are dark green shading with dark green lines. So they're bullish, interestingly enough, along with staples, which is your other safe haven area. And then you can see the cyclical areas, financials getting back to the moving average, technology getting back, discretionary trying to get back up there, and then the communication services looking even better. So they're not really bullish or bearish. They've got the mix of this dark pink shading, but they don't have red lines like some of these other sectors do. All right, so remember one of the areas that is still showing that kind of bearish combination in the sector standpoint is industrials. We'll look at the airline sector, in particular United Airlines here. It's got the dark pink shading. It's got the red line itself. It's below the moving average. Hasn't really bounced up as much as what the market has done, so lagging behind there. If you look at its 3 red arrow chart here, you can see it's got 3 red arrows. It never did get that stochastics red arrow, and if you look at the 2-line versions of these charts, we're still below the 8-day moving average, and MACD and stochastics are still down 2. Let's take a look at the Bollinger Bands here for United, and you can see that it's there's some pressure up here. There's a lot of supply. Now it's not going to break down easy, but if it does break below this 81.5 level, there's not a whole lot of volume down here at all. Like there's a few touches here at 80, and there's the bottom end of this range, but then after that, very, very little volume from a 1-year standpoint. So a lot easier for it to fall to the downside out of this little sideways action than move up to the upside because of all of that overhead supply that's leading in. If you look at the DMI here, you can see that this orange line has pulled back down below 25. A breakdown would bring it back up, but the green line or the red line, blue line, sorry. I don't know what I'm saying here. It's still easily below 20. So, we're not getting, a bounce opportunity here from what these lines are telling us. We're just getting a pause in the selling, and this would suggest that there's more likely that we'd get a renewal of selling than we would get a bounce of buying. Of course, nothing's 100%, but that's what these indicators would suggest. Finally, from a long-term viewpoint, you look at its long-term chart here, and you can see, it's been kind of sideways. You see that it's got some room to go to the downside. And if you, depending upon the type of trade, if you sell the calls sell the call at 85 and buy the 87.5 for protection, you get a decent credit. It doesn't need to break down too far as long as it stays below 85. And if you see where that is, you can see that blue line on the chart. That's where that line's coming from, right here. That's where that line's coming from. So in fact, it'd have to get a back up above this volume node here, and back above the moving average in between the Bollinger Bands. And the key too on this trade is it would have to get back above the moving average, because that's where the red moving average, that's where that break even is. So that's to that point, a little bit beyond it is where we would end up taking what would be willing to take a $72 loss before moving on to something else. We got a lot of opportunity for it to stay down because of what we have up above it. All right, so as always, that wraps us up for today. Now I want to hear from you. Use that link popping out up there in the top right corner of your screen. It takes you to our Market Outlook forums on marketscholars.com. Open up any new thread with questions or comments on anything we discussed in today's video or anything we didn't discuss that relates to what we talk about here. Remember, you can also reply to other people's threads as well. Let's keep this conversation going until tomorrow's Market Outlook. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment on the video. Follow me on Twitter for more content in between videos, and join our community on our website, marketscholars.com, as well as the one that we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.